All right, let's jump right in. Today, we're talking about a massive, invisible force that's constantly pulling the strings on your entire portfolio. It's the unseen power that's moving your money, whether you know it or not.
So, have you ever had one of those days you're staring at your screen, just watching in horror as your stocks and your crypto are both nosediving at the exact same time? You probably thought, wait a minute, aren't these supposed to be different worlds? Well, they're not, and there's a very specific reason they move together, and that's the mystery we're cracking today.
The answer, in 2 words, is global liquidity. The best way to think about it is like a giant, invisible tide for the entire global financial system. When the tide of money comes in, it lifts all the boats. We're talking stocks, bonds, real estate, and yep, crypto too. But when that tide goes out, everything gets left high and dry.
Okay, so let's break this down a bit more. To really get a handle on how powerful this force is, we first have to understand what or who is controlling this tide.
You know, this global tide doesn't just happen by accident. It's mostly controlled by the big players, the major central banks like the US Federal Reserve. Their decisions are everything. When they change interest rates or when they decide to either pump money into the system, that's quantitative easing, or pull money out, that's quantitative tightening, they're basically deciding how much cash is sloshing around the world's markets.
So, to see how this works in the real world, let's look at traditional finance first, or TradFi as they call it. This is where we can see the patterns most clearly.
It really just boils down to 2 basic states of being. You either have high liquidity, think of it as a flood of easy, cheap money, or you have tight liquidity, where someone's pulled the drain and money becomes hard to find. And each one creates a totally different vibe in the market.
When those floodgates are open and liquidity is high, man, it's party time. Money is cheap to borrow, so people and companies start spending and investing like crazy. That optimism sends stock markets rallying to new highs. And with so much cash looking for a place to go, everything from bonds to commodities gets a lift. It's a pretty calm and confident market.
But when the central banks start pulling the plug on that drain, whoa, the whole mood changes. Suddenly borrowing gets expensive, so everyone, companies, consumers, they all tighten their belts. Stock prices start to drop, and you see investors sprinting for cover in so-called safe assets. This is usually when you start hearing the R word, recession, getting thrown around.
And look, this isn't some abstract economic theory. We all just lived through a perfect, real-world example of this. In 2020 and 2021, central banks unleashed a tsunami of cash to deal with the pandemic. And what happened? Stock markets went vertical. Then, in 2022, the Fed pulled the drain by jacking up interest rates, and almost every single market took a nosedive.
Now let's switch gears and talk about crypto. If traditional finance is a car, crypto is like its high-octane cousin with a rocket strapped to the roof. It runs on the same fuel, liquidity, but the reactions are way more extreme.
During one of these liquidity floods, the crypto market just goes into what you'd call full send mode. People have extra cash, they're feeling risky, and they start throwing money at more speculative stuff. This is when you see Bitcoin just take off, altcoins go absolutely parabolic, and the whole DeFi space just explodes.
But when that liquidity drain happens, that appetite for risk just vanishes overnight. And since crypto is seen as one of the riskiest assets out there, it's usually the first place people pull their money from. The entire market cap shrinks, altcoins get hit even harder than Bitcoin, and all that venture capital money for new projects, it just completely dries up.
And the scale of this is just staggering. During that big liquidity drain in 2022 and 2023, the total value of the entire crypto market dropped by about 70%. Just let that sink in. More than 2/3 of the market's value gone, just as that tide of money went out. And this maps perfectly onto those crypto cycles we all know so well. That epic 2020 to 2021 bull run that took Bitcoin from around $4,000 to nearly $70,000, that was fueled directly by that huge wave of liquidity. And the brutal bear market that came after, that was a direct result of the liquidity getting sucked out of the system.
So this brings us to the most important question, right? Why? Why are these 2 worlds, which were supposed to be completely separate, now chained together by this one single force?
Well, the simple and most direct answer is this. They just aren't separate worlds anymore. That wall that used to exist between them, it's gone.
You see, a bridge was built, step by step. First, you had the big institutions and hedge funds dipping their toes into crypto. Then, they started trading both stocks and crypto in the same portfolios. And now, with things like Bitcoin ETFs, that bridge is basically a superhighway, connecting the 2 worlds for everybody, more tightly than ever before.
And this quote here just nails it. Because they're so connected, when central banks turn the money tap on or off, both stocks and crypto move together. But here's the key difference. Crypto is kind of like the canary in the coal mine. It tends to react first, and it definitely reacts harder.
Okay, so this is all really interesting, but how can you actually use this knowledge? Because this isn't just theory. This can become a brand new compass for navigating the markets. It's really about learning how to spot the signs that the tide is turning, maybe before the rest of the market catches on.
So what are the key things to watch on this new compass? Well, definitely keep an eye on the Fed's balance sheet. Is it getting bigger or smaller? You'll also want to look at broad measures of money supply. But here's a really powerful crypto-specific one. Watch the total supply of stablecoins like USDT and USDC. When that number starts climbing, it's a huge sign that new cash is sitting on the sidelines, ready to get deployed into crypto.
So here's the bottom line. When you see these key indicators start to point up again, when it looks like global liquidity is starting to expand, that's your early signal. That's your heads up that the market might be shifting back into a risk-on phase.
And that's really the power of this whole idea. It's about zooming out. Instead of getting lost in the weeds of a single price chart, you start to see the entire macroeconomic ocean that all these assets are swimming in. It just gives you a totally different perspective.
Because, make no mistake about it, the tide is always turning. The cycles of floods and drains, booms and busts, they're going to continue. So the only real question is, are you going to be ready for the next wave?